Good morning and welcome to TOITOI Japan Market Radio. I'm your host coming to you from Tokyo on December 21, 2025. We're here to give global investors a concise briefing on what's moving Japanese equities, the yen, and yields. Joining me today is our portfolio manager who focuses on Japan macro. Thanks for being here.
Thanks for having me. Before we dive into the news flow, I should mention that the Japanese market was actually closed today for a holiday. So we're looking at how global developments are likely to influence Japanese assets when trading resumes. The key themes we're watching are U.S. equity momentum, particularly in technology and AI stocks, corporate moves by major Japanese financials, and the ongoing dynamics around central bank policy divergence.
Let's start with what's happening in U.S. markets, because that obviously sets the tone for risk appetite globally. We're seeing headlines about a stalled Santa rally despite the Federal Reserve moving toward what looks like a near-certain December rate cut. Can you walk us through why U.S. equities aren't responding the way markets typically expect when the Fed eases?
It's an interesting dynamic. Traditionally, a Fed rate cut combined with the seasonal year-end optimism would drive equities higher. But that's not playing out this time. What we're seeing instead is a risk-off tone persisting even as monetary policy becomes more accommodative. This suggests investors are concerned about something deeper, whether it's growth expectations, valuation levels, or uncertainty heading into year-end. For Japan, this matters significantly because Japanese equities are highly correlated with U.S. risk sentiment.
So when that Santa rally fails to materialize, what does that mean specifically for Japanese stocks when they reopen?
It creates headwinds on multiple fronts. First, the lack of positive momentum from U.S. equities removes a key tailwind that Japanese indices typically rely on. Second, and perhaps more importantly, this kind of risk-off environment tends to strengthen the yen as investors seek safe haven assets. A stronger yen is a direct headwind for Japanese exporters, which make up a significant portion of both the Nikkei 225 and TOPIX. We're likely to see pressure on export-oriented names when trading resumes, particularly if the yen continues to appreciate on safe haven flows.
And on the currency side, you mentioned yen strength. With the Fed cutting rates while the Bank of Japan maintains its tightening bias, that policy divergence must be playing a role here.
Absolutely. The widening divergence between U.S. rate cuts and the BOJ's relatively hawkish stance supports yen appreciation. When you combine that with the risk-off tone we just discussed, you get a compounding effect. We could see USD JPY moving lower, meaning a stronger yen, which as I mentioned creates earnings headwinds for Japanese multinationals. It's a mixed picture because while a strong yen can help import-dependent sectors and consumer purchasing power, the immediate market reaction tends to focus on the export competitiveness issue.
What about Japanese government bonds in this environment?
In a risk-off environment, we'd typically expect to see a bid for government bonds, which would push yields lower. However, the BOJ's positioning complicates this. If the Bank of Japan holds steady on its policy path while global risk sentiment deteriorates, we might see the JGB curve steepen modestly. The impact on yields is probably going to be more muted than what we see in equities or currency, but the direction would likely be downward for now given the safe haven dynamics.
Now, there's been some more encouraging news out of the US as well. We're seeing reports that AI stocks have turned higher again, with Wall Street enjoying a rebound in that sector. This seems to be reversing some recent weakness in technology. How does that AI rally translate into the Japan story?
This is actually quite positive for Japan when you break it down. The AI trade has been a major driver of global equity performance, and Japan has significant exposure to this theme through its semiconductor and electronics sectors. Companies like Tokyo Electron, Advantest, and Sony are direct beneficiaries of sustained AI infrastructure demand. When US AI stocks rally, it typically signals strong end-market demand for the components and equipment that Japanese firms supply.
So the semiconductor names in particular should see some support when Tokyo trading resumes?
Exactly. The Nikkei has substantial weighting in cyclical tech-related sectors, so US AI momentum tends to translate fairly directly into positive performance for Japanese semiconductor manufacturers and electronic equipment makers. Beyond the direct business impact, there's also the risk sentiment channel. Strong US tech performance generally supports global risk appetite, which reduces safe haven demand for the yen. That would actually be a positive for Japanese exporters from a currency perspective, the opposite of what we discussed with the stalled Santa rally.
So we have these competing forces, the risk-off tone from the broader market stall versus the risk-on signal from AI stocks specifically.
That's right, and it creates a nuanced picture. If the AI rally can broaden out and pull the rest of US equities higher, that would be unambiguously positive for Japan. But if it remains narrow, confined just to a handful of mega-cap tech names, then the benefits to Japan are more limited and the risk-off undertones we discussed earlier could dominate. The key for investors is to watch whether this AI strength can actually shift overall risk sentiment or if it's just a sector-specific move within a more cautious market.
The other dynamic here is what it means for yen direction, because you mentioned reduced safe haven demand if risk appetite improves.
Yes, a sustained US equity rally driven by AI and tech would typically put downward pressure on the yen, meaning USD, JPY would move higher. That benefits Japanese exporters through more favorable earnings translation when they repatriate dollar revenues. However, the BOJ would be watching this closely, because if yen weakness becomes too pronounced, it complicates their inflation and policy outlook. It's always this balancing act between what's good for exporters versus what central bank policymakers are comfortable with.
Meanwhile, in corporate news, we're seeing a major strategic move by MUFG. Mitsubishi UFJ Financial Group has announced a $4.4 billion stake acquisition in Shriram Finance, an Indian non-bank financial services company. That's a very sizable capital deployment. What's the strategic rationale here?
This move really underscores the structural challenges facing Japanese financials domestically. Japan's banking sector operates in a mature, low-growth environment with structural headwinds from demographics and persistently low interest rates. MUFG is essentially looking to offset those domestic constraints by building exposure to higher-growth emerging markets, and India's financial services sector offers exactly that growth profile. This is about earnings diversification and seeking returns that simply aren't available in the domestic Japanese market.
Does this have broader implications for how we should think about Japanese financial institutions?
It's part of a longer-term trend where Japanese banks and insurers are increasingly looking overseas for growth. MUFG is the largest banking conglomerate in Japan, so this $4.4 billion deal is a significant signal about where management sees the best risk-adjusted returns. It also reflects Japan's broader geopolitical positioning in Asia, strengthening financial sector footprint in India amid regional competition. From a portfolio perspective, investors in Japanese financials need to understand that the growth story is increasingly tied to these international operations rather than the domestic business.
What about the market impact when Tokyo reopens? How should we expect MUFG shares to react?
In the near term, the reaction is likely to be modestly positive, reflecting confidence in the return on investment potential of this deal. However, there's always dilution risk if valuations prove stretched or if the integration doesn't go as planned. For the broader indices, the impact is minimal because this is really a stock-specific story. MUFG has about 5 to 6% weighting in the Nikkei, so even a significant move in the shares doesn't drastically change the index direction. This is more of a tactical story about MUFG's fundamentals rather than a macro signal for Japanese equities overall.
What about the yen implications, given this represents significant capital outflow?
The deal represents roughly 650 billion yen equivalent flowing out of Japan, which theoretically could weigh on yen demand in the short term. However, in practice, MUFG almost certainly hedges its currency exposure on transactions of this size, so the actual impact on USD, JPY is probably neutral to very slightly negative. It's not the kind of capital flow that would materially move the currency, especially given the much larger forces at play from monetary policy divergence and global risk sentiment.
And I assume Japanese government bond yields aren't really affected by this kind of corporate transaction?
Correct, there's no material impact on JGBs. Domestic capital allocation by a Japanese bank doesn't really influence the BOJ-dominated yield curve. The JGB market is much more driven by central bank policy, inflation expectations, and global sovereign bond dynamics than by individual corporate capital deployment decisions.
So pulling all of this together as we head toward the close, what are the main themes global investors should be focused on for Japanese markets right now?